Welcome, everyone. Thanks for being here today. I'm so glad that you're able to join. And for those watching replay, thanks for coming. Today, we're going to step into the new year, kind of look ahead with a fresh perspective on our financial goals. The new year is a perfect time to reflect and plan, an opportunity to really take stock of where you are financially, identify the gaps, and set actionable goals to move forward. Before we dive in, I'd like to share a verse from the Bible that's been hitting me hard this week. It's from Proverbs. The plans of the diligent lead surely to abundance, but everyone who is hasty comes only to poverty. This verse reminds us that careful planning and diligent, steady progress ultimately lead us toward abundance, while rushing ahead without a plan can cause setbacks. We'll use this principle as our guiding kind of principle today as we walk through practical New Year's financial resolutions for your Shopify store, from setting clear revenue targets to understanding key financial ratios, managing your inventory, and having a solid pack strategy. And we'll go through strategies that really encourage you to be intentional and thoughtful, diligent really, so you can move forward with greater financial health and freedom in the coming year. All right, let's get started. My name is Jacob Curtis. I'm a CPA, a certified private first professional, and a business coach. And I really started Curtis Accounting Solutions to remove the stress of doing the bookkeeping, payroll, taxes, and to provide practical business advice that helps Shopify stores piece together financial freedom. I'd love to hear your thoughts and questions on today's episode, so please leave a comment below and remember to like, share, follow, and subscribe. Okay, let's dive in. As we approach a fresh start in the beginning of a new year, the first resolution I'd encourage you to set is to define a clear revenue goal for the coming year. It's not enough to say, I want to sell more. You need to know how much more, by when, and at what profit margin. For example, if your store generated $120,000 in profit last year, setting a goal of a 20% increase would mean aiming for $144,000 this year. Breaking that down monthly, and you get about $12,000 in revenue per month on average. So this target really helps you plan your marketing campaigns, product launches, and promotional activities. By establishing a realistic yet aspirational revenue goal, you can create a roadmap that informs decisions like which advertising channels to invest in, when to run seasonal sales, and how much inventory to stock. Without this clarity, it's like trying to navigate without a compass. With it, you can measure your progress, adjust course if needed, and stay on track towards growth. Ask yourself, is my revenue target achievable given my historical trends and market conditions? How can I allocate resources to hit it? And that's the mindset you want to have for this new year. One common struggle for Shopify owners is managing cash effectively. Profit First is a cash management framework or system that encourages you to allocate funds into different accounts right after each sale, or ideally every couple of weeks. For example, say you receive a $1,000 sale. Instead of putting $1,000 into a single checking account and hoping expenses don't eat it up, you'll allocate that money across a few dedicated accounts, including profit, owner's comp, taxes, operating expenses, maybe even inventory. And according to some predetermined percentages, you'll make those allocations. Maybe it's 5% to profit, 50% for expenses in the operating account, 30% to the owner's pay, and 15% into the tax account. By consistently following the system, you're forced to live within the constraints you set, ensuring there's always a portion of revenue earmarked for your profits, for your own pay, and for your tax obligations. Over time, this creates a disciplined approach that protects your profitability, minimizes nasty year-end surprises, and offers you some peace of mind. It's not just about making sales, it's about ensuring that when you do, you keep a portion as profit. This system can transform how you perceive and handle money, giving you a healthier, more stable financial environment all year long. Now, inventory is often one of the largest expenses for Shopify sellers, and mismanaging it can seriously hurt your cash flow. Start by reviewing last year's data. Look at what products move fast and which sat on the shelf. For instance, if a particular item sold out 3 times last year, you might plan to order 20% more upfront this year to meet that demand. Conversely, if you have products that gather dust, it might be time to discontinue them or order them less frequently. Track your inventory turnover ratio. If you spend $50,000 on inventory last year, or you spent $50,000 in inventory last year, and your average inventory on hand was $10,000 at any given time, your inventory turnover is 5. Maybe your goal is to increase that turnover to 6, indicating that you're moving product more quickly, tying up less cash, and reducing the risk of outdated stock. Improved inventory management leads to better cash flow, more satisfied customers, and fewer headaches. Next up, Your bookkeeping process. Staying on top of your books is crucial, yet it can feel overwhelming if you're doing it all manually or playing catch up at tax time. Consider integrating your Shopify store with your accounting platform. Automations can pull in daily sales, fees, and expenses, drastically cutting down on manual data entry and reducing the errors. Make a habit of reconciling your accounts monthly. This ensures your reports, your income statement, your profit and loss, balance sheets, your cash flow statement are always up to date. Let's say that at the end of each month, you confirm that your Shopify deposits match what shows in your bank account and your credit card charges match your statements. Spending 30 minutes doing this every month is much easier than scrambling for hours at year end. Over time, streamlined bookkeeping will give you clearer financial insights, making it easier to spot trends, prepare for tax season, and to strategize. Now, numbers don't lie, and understanding a few key financial ratios can shed light on the health of your business. Start with your gross profit margin. If you earned $100,000 and your cost of goods sold was $50,000, your gross profit margin was 50%. This ratio helps you understand how profitable your products are before overhead expenses. Next, consider your current ratio, which indicates liquidity. If you have $40,000 in current assets, cash, inventory, receivables, that kind of thing, and $20,000 in current liabilities, your current ratio is 2. That means you have twice as much short-term assets as long-term assets, or long-term debts, I should say, indicating a relatively comfortable liquidity position. Finally, turnover, inventory turnover specifically. As discussed, if your COGS is $50,000 for the year and your average inventory is $10,000, your turnover is 5. A higher number means you're selling inventory quickly, improving cash flow. Understanding these ratios isn't just academic. It provides actionable insights. For instance, if your gross profit margin is declining over time, maybe you need to raise your prices or find cheaper suppliers. If your current ratio is below 1, you may need to tighten some expense controls. Now, these ratios guide decision-making and keep you steering in the right financial direction. Cash flow is the lifeblood of your business, and forecasting it helps you anticipate surpluses and shortages well in advance. Create a simple spreadsheet projecting your income and expenses over the next 3 to 6 months. If December brought in $20,000 in revenue, consider how January's revenue might differ, perhaps due to post-holiday slowdowns, and plan accordingly. If you know you'll need to restock inventory at the start of spring, project that expense now. For example, let's say your average monthly revenue is $10,000, and your monthly fixed expenses like rent, subscriptions, utilities, that totals $3,000. Plus an average of $4,000 for inventory replenishments every other month. By mapping this out, you can see if a month where you restock heavily might temporarily dip into your cash reserves, below your comfort level or your comfort threshold. If so, you can prepare in advance. Maybe you run a targeted promotion in the previous month to boost those sales, to boost that cash flow. Regular forecasting and updating as new sales data comes in keeps you one step ahead, reducing surprises and increasing your peace of mind. Pricing is both an art and a science. Setting prices too low can undermine your profits. Setting them too high can drive away customers. Start by analyzing your cost structure. If your best-selling products cost you $20 and you're currently selling it at $35, you're making $15 in gross profit per unit. That's okay. But what if a slight increase to $37 doesn't scare away customers and boost your profit per unit to $17? Over 1,000 units sold, that's an extra $2,000 in profits. Research your competitors. If a similar product is sold at $40 elsewhere, maybe you have more room to increase. Or if competition is fierce, perhaps you differentiate by offering bundles or premium add-ons. Test small increments. Start with a 5% increase and monitor sales volume. Evaluate the overall impact on gross margin and the bottom line. Adjusting prices strategically can have a substantial cumulative effect on your annual profitability, and now is a great time to test that out. As a Shopify entrepreneur, your time is valuable. Outsourcing tasks that aren't your specialty, like bookkeeping, inventory management, or even customer support, can free you to focus on product development and marketing. Let's say you spend 10 hours a month reconciling your bank statements, updating spreadsheets, and handling administrative tasks. If you outsource this work for $500 a month to a reputable firm, or bookkeeping service, or a virtual assistant, you can use that freed up 10 hours to possibly boost sales by $1,000. That's a net gain. This doesn't mean handing over control blindly. Carefully vet your outsourcing partners and establish clear processes and expectations. By delegating routine tasks, you can concentrate on strategic activities that directly impact your bottom line. Over time, this shift in focus can significantly accelerate your business growth while reducing stress and burnout. Success in business isn't a set it and forget it proposition. You should schedule regular financial checkups, ideally at the end of each quarter, if not more. Review your income statement or your profit and loss statement, balance sheet, and cash flow statement. Compare actual results to your forecasts. Are you hitting your revenue targets? Is your gross profit margin stable or eroding? Did seasonal trends play out as expected? For example, a Q1 sales came in 15% below your target. Assess why. Was it due to reduced marketing spend, supply chain delays, or competitors' promotion, or something else? Use that insight to adjust your Q2 plans. These quarterly reviews can reveal patterns. Maybe Q3 historically lags due to back-to-school season and reduced online shopping. Armed with that knowledge, you can plan marketing campaigns or inventory decisions to mitigate slowdown. By regularly checking in with your financials, you stay agile, proactive, and ready to capitalize on new opportunities to handle challenges before they become full-blown crises. Now, taxes are often top of mind at this time of year, but a strong tax strategy is built year-round. Ensure you know your filing deadlines, both income taxes and sales taxes, as well as payroll taxes if you have employees. Identify which expenses are deductible: advertising costs, software subscriptions, shipping fees, perhaps even you qualify for some home office expenses. Suppose you grossed $200,000 in sales and had $120,000 in deductible expenses. You're taxed on $80,000 of the profit, not the $200,000 in sales. Tracking and documenting these expenses throughout the year can save you thousands in taxes if you do it correctly and throughout the year. Also, don't hesitate to seek professional guidance. A CPA experienced in e-commerce can help you identify credits, deductions, and strategies tailored to your niche. Even if a single piece of advice, such as properly classifying certain expenses, can lead to substantial tax savings. Remember, a solid tax strategy is proactive, not reactive. As we wrap up, let's circle back to that verse we started with in Proverbs. The plans of diligent lead surely to abundance, but everyone who is hasty comes only to poverty. The resolutions we covered today, from setting clear revenue goals, adopting a proper system, to improving inventory management, streamlining your bookkeeping, understanding key financial ratios, forecasting cash flow, optimizing your pricing, exploring outsourcing, and scheduling quarter reviews, and building out a solid tax strategy are all about being diligent. They're about planning, acting with intention, and consistently refining your approach. These steps won't guarantee overnight success, but they will help you lay a strong financial foundation, guiding you toward that abundance that the verse speaks of. Implement these resolutions carefully and review them regularly. Over time, this will help you remain profitable, sustainable, and positioned for steady growth. If you have any questions or need assistance with managing your company's finances, please don't hesitate to reach out. I'm here to help you piece together financial freedom. So schedule a call to get started by scanning the QR code on the screen or going to jacobcurtiscpa.com/7-Shopify-mistakes-calendar to get started, or just click that link below in the first pinned comment. Remember to follow me, Jacob Curtis CPA, and Curtis Accounting Solutions on Facebook, Instagram, Pinterest, and YouTube. Thanks for watching, and we'll talk to you soon.